The August real estate numbers are in, and the biggest takeaway, sales are down 40% from this time last year. Hey everyone, welcome back. Here we go. The August real estate numbers are in. And as mentioned off the top there, the biggest takeaway, at least what you're going to hear the most in the media, is that sales dropped 40% compared to last August. We ended up with about 1,870 homes that sold last month. Obviously, that's very low. It's actually closer to 41% lower sales than this time last year. It is an additional 0.9, let's call it 1% from last month as well. Overall, if we look at the bigger picture here, the 10-year average, sales are about 29% below that 10-year average. This is obviously well below norms, but again, somewhat around what we've been seeing for the last 2-3 months. If memory serves me, I believe the July numbers were something like 35% below that 10-year average. This is the 5th month in a row of declines that we've seen and the lowest August sales in 10 years.
Wow. It's not often that, we knew that it was going to be bad, but 1,870 sales is very low. And, 41% decrease off of August of last year. Whew. That's a different flavor in the market. With that being said, there were 3,328 properties newly listed for sale in August. That is a decrease of 17.5% compared to August 2021 and a 16% decrease compared to July last month. That's a 20-year low in new listings for the month of August, which is very interesting because, and we'll talk on some of these anecdotal stories, but as we see less and less inventory, we're also seeing some buyers starting to mount. And we've seen a little change in activity, but we'll get into that once we talk about the sales to active. For now, Dan, let's touch on some more inventory.
Yeah, so obviously with really low listings, we're seeing really low inventory, or at least it's stabilized, let's just say. Now, we're sitting at under 9,700 total active listings. We've been saying for a few months it wouldn't crack 11,000, but we weren't certain, or we weren't sure that it was going to drop this much. This is a little bit unprecedented what we're seeing in our market here, especially when you reference it to the rest of what's happening across the nation. 3% decrease in active listings from this time last year, and about 6% less than just last month. There are less and less homes on the market through summer. Take this very seriously, and I think this is what I think is the biggest takeaway that you should really, really pay attention to here. Because last month, across Canada, nationally here, we're talking, inventory increased 45% on average. Don't have the August data yet, but it's going to likely be similar. So nationally, we're seeing an average of 45% increase, and yet GVRD is down year over year. It is showing once again, not only how resilient the market is, but how almost independently it operates compared to the rest of the markets, even Toronto, for example, which it often emulates. Now, on an annual cycle, overall inventory has been dropping for 4 years straight. And I'm going to put up a special chart for this one because it's interesting. You'll see the cycles. Obviously, things slow in summer and they slow in winter. But overall, you see these cycles, and this is the 4th year in a row where the overall cycle is moving lower and lower in the overall inventory count. Oh, sorry, that's me. I will put that on airplane mode because I forgot. Okay, apologies. Edit, we're back. For reference, 10 years ago, we're talking August of 2012, there were 18,800 active listings. That is double where we are today. And yes, that's 10 years ago, but let's also think of it with this aspect. Population in GVRD is also up by 300,000 people since then. So our inventory is half of what it was 10 years ago, yet population is up by 300,000 people. Do you see what might be coming on the other side of this? Again, it's not the only metric, but it is a very important one. So keep that in mind as you see what happens in the next few months here.
Yeah, it's not something you can ignore. When you look at the fact that we've got, mounting pressure from interest rates that are still coming into the market, I don't think that's going away. I think we're going to continue to see added pressure. But when you've got 300,000 more people in the city and nowhere near that level of construction that's taken place to help with that increase in population, it's no wonder that even in a downward market, we're still seeing the odd multiple offer, especially in very desirable neighborhoods. So it's really, really hard I think, to say that things are going to be really bad for a long time when you have this kind of underlying pressure, right? Let's look at the sales to active ratio. Overall, 19.4%, which is a balanced market, and that's our second month in a row. Generally speaking, one more month and we are in a long-term, quote-unquote, balanced market. So we'll see where that goes. A few changes. First of all, even though we're still inside this balanced market, let's not forget that we're actually up 1.1% from last month, and we are teetering on that seller's market, right? 20% and onwards is the seller's market. So it's the first increase we've seen in about 4 months. So good news for some sellers. Definitely looks like we're plateauing here. It looks like some stability is coming back into the market, maybe the return of some consumer confidence here. We'll see. But all three property types saw an increase as well. So it's not just predominantly in one area. All property types inched up, right? So that's a significant change in attitude across the market, and it's also setting up what Dan and I feel is going to be a little bit more robust fall market here. I think it's important to think of the sales to active ratio as sort of a pressure gauge on the market. It's kind of the best way to look at the dials and see where are we going from here, right? So when we look at detached homes, still well within a balanced market here, 12.2%. Townhomes up more than 5% back into a seller's market at 25.3%. And apartments hovering right around the same 24.8%, maintaining that seller's market.
Very interesting to see that inch up for the first time in 4 months. That really does talk to the underlying changing circumstances that we really do feel in the marketplace here. But let's talk about price. HPI, the biggest indicator, the one that the media tracks, is now under 1.2 million. We are at $1,180,500. That is the average price of a home. That is down another 2.2% from just last month. And if you remember back in June, that did 2.3%. So we are now down a total of 7% from the April peak, or the equivalent of $84,000. Annually, year over year, we are still 7.5% up from this time last year. Okay, that's one picture. Move on now to, of course, the median and the average. So median did tick down last month as well, though not too much. It went down $14,000. Median is now sitting at $886,000 overall. From the high, from 6 months ago at the peak, we're down 13% with the median, or an equivalent of $114,000. Let's take that same look over at average prices now, where average homes are sitting at $1,189,700. Okay, that's down $17,000 from last month. So 14 on median, 17 on average. It's down, but it's a little bit stabilized compared to what was happening 4 or 5 months ago. From the peak, just like median, average home prices are down 13%. That equates to $138,000. Very interesting to see those two operating in unison here. And of course, as we mentioned, HPI is a lagging indicator. So we're seeing both median and average stabilize somewhat, HPI is down 7.5%. You're going to see that drop next month as well, likely in the 2%-ish range, which will again bring it down to, let's call it 9.5-ish, but we're still sitting at 13 for median and average. So it will creep down there. Median average next month is going to be very interesting. It's a harder one to predict, and we'll kind of give some of our predictions near the end of this episode.
Yeah, especially when you consider the uptick in activity that we've seen recently here. We haven't quite seen the inventory. Well, it's clear we have not seen inventory growth. So it's like you said earlier, Dan, it's setting up for a very interesting fall. Where I think we're going to see some more fireworks potentially. We'll see how that plays out. So let's talk about sales here. Although they were not super robust, we'll break them down here for the month of August. 517 single-family homes sold. That's a whopping 45% decrease from August of last year. But the average price now for single-family homes at $1.954 million. A 7.9, call it 8% increase from August 2021, but a 2.3% decrease compared to July of 2022. So declining in value there. Apartments, 998, about 1,000 apartments sold, the majority of the sales. 38.8% decrease compared to 2021 of August. The average price sitting around $740,000. It's an 8.7% increase from August 2021, but again, a 2% decrease from July last month. Townhomes sitting at 355 sales, 38.4% decrease compared to August of last year. The price now sitting at $1,069,000. That is roughly a 13%, just under 13% from August of last year. But again, a 2.5% decrease compared to July 2022. And Dan, honestly speaking, your prediction here of HPI dropping another 2% is in line with all of these metrics, right? So I tend to very much agree with what you're saying.
Perfect. I appreciate that. Okay, so a couple of more metrics we always like to share with you that you typically don't hear anywhere else. First one being days on market. And this is an interesting one because we saw a massive 7-day increase in your average days on market, now up to 19 on average. We were at 8 just back in April. So we have more than doubled here. Keep in mind, sure, back in 2015, days on average was upwards of 30, 35. Though, if you're a seller now, you have to recognize how much things have shifted. It is no longer that market it was in January, February, March, April, when you could sell almost guaranteed in 1 week. You are now looking at upwards of 3 weeks to sell your home on average. And buyers, same thing. You may have a little bit more opportunity and not have to see that home the first 2 days on market to even have a chance. So the playing field is leveling a bit, if you will. On a per foot basis, that's dropping as well. The average home dropped $15 per foot, now averaging $804. This is down $82 a foot since the high back in February of just this year. Percentage of list price. Remember when everything was selling for over ask not too long ago? That is no longer the case. When you see a home listed, you can expect to buy it for about 3.5% below that list price. 96.4% of list price is what things are selling. That's down an additional 1.2% from last month, but we're down 9% from where it was 6 months ago. And that's when things absolutely were selling over ask on average. We're back to basically May of 2020 numbers. And that's when we were shut down. That's when you could barely buy a home. Yeah. We are back more than 2 years here in that ratio, or in that metric rather.
Interesting here too, Dan, when you consider where we're at with days on market at 19, that's assuming that you get it priced right too, right? I mean, we've seen homes now 100 plus days, 120 days on market, right? So pricing right now, your strategy going to market is critically important if you intend to sell in those days on markets, right? So
very true.
Especially as
it's a far from perfect metric, because if somebody is, like Ryan mentioned, on market for 150 days, then they do a great price reduction and they're more in line and it sells within 2 weeks, that's the number that's registering. Yeah. So while you can extrapolate data and get, total days on market to sale, this is the one that is sort of shared the most often. But again, this is with homes that are obviously priced right and do sell.
Yeah. It's an important part, because there's a lot of sellers out there right now who, even though we've gone through a significant change, they're still not getting off their numbers, and those days on market are climbing existentially. That being said, kind of want to talk about some anecdotal stories, and also wanted to bring up something that is very interesting. You're probably not aware of this, because we have some connections in the education side, the education field. And if you can believe this, Dan, in the last week and a half, there have been more than 5,000 applications for kids to get into school. The vast majority of those coming in the last week from Hong Kong. The VSB only has 1,200 spots available.
Oof, ouch.
So we are going to see an interesting influx of people that's going to affect the rental market and the sale market here. Now, we don't know necessarily if all of those people coming back have homes already here. Are they coming back to reoccupy them? If they are, then that's going to put a lot of pressure on rental, which is already here. Conversely, if they don't have places that they own and they're looking to buy, you could expect a busy September, especially here in Vancouver West, Vancouver East.
Do you know how does that compare to previous years?
Unprecedented. It's crisis level.
Fair. The VSB could create a new revenue stream and create multiple offer bidding scenarios for getting your children into school. And yes, I'm kidding. Don't write your hate mail here. This is a joke. But again, when there's that much demand, obviously you can attach a monetary gain to it, should you be able to or want to.
And we've talked about how appealing Vancouver is on a global scale. And this is evidentiary of that. And I think it's important for people to recognize that as we continue to go through this year, and yes, there's going to be all kinds of pressures, macro pressures taking place, but there's also local pressures that take place. And when you start to see things tick up in the slowest time of the year, and then priming for what's going to be, in my opinion, probably quite a busy September. And we'll see where that goes in terms of new people arriving here. But I think without a doubt, you're going to see quite the pressure put on the rental market first, with more sustained sales coming. I mean, we had 1,800 sales in August, and we got, more than 5,000 applications coming here just for the school, right? So put those numbers into perspective.
One of the things that you experience as a licensed agent here is you really get a sense of what's coming next, especially for groups like ourselves. We're a team of 7. We talk with agents every single day here, and we've all felt in about the last 7 to 10 days an increase in interest levels. The phones ringing again, the inbound requests, inquiries, etc. are all here. Our group alone was in multiple they are kind of awful. Multiple offer scenarios 3 times just last week. And that is the norm. I'm sorry, that is the exception. That is definitely not the norm. It has not been normal for some time. It's an outlier. One of our colleagues offered on something in Surrey that had 17 offers on it last week. Is that an outlier? Absolutely. But is it an early indicator of increased interest levels? I'm going to have to say yes. We've seen, again, these record low sales numbers for a couple months now. We've got this underlying housing inventory crisis that has been here for decades now, and it is all kind of coming to a head. Now, that said, what else is happening next week? It's going to be interesting, because Wednesday, September the 7th, is the Bank of Canada's next rate announcement, and it is widely believed the markets have priced in a 0.75% hike. Could be that, could be 0.5. It's likely, almost certainly, going to be one of those two. It may be the last hike of the year? It may not. We might see one more in December and end up another 100 basis points higher than we are today. And of course, that is going to dampen any type of rebound here. As much as 7 to 10% further price erosion could happen because people that are buying at the top of their budget, which 95% of people do, will see their budget reduce by 7 to 10% based on how many future hikes come in this year. And that's a lot.
And I feel, as we've seen historically in Vancouver as well, if sellers don't get the number or reasonable number for their home that they deem reasonable, they won't sell it. So again, yes, we're going to see erosion of purchasing power, but the underlying demand and the underlying inventory issues that exist in our local market, as we've seen comparatively speaking to Toronto, we haven't dropped in that respect. We haven't seen the inventory spike level come up to a point that, like you said, it was 18,000 listings a decade ago, right? By comparison, that's your 10-year average that we're looking at. And this is just, it's still a crisis. It's still a problem here. It's not changing. It's just changing the ferocity. That's what's changing.
Vancouver is a bubble in a sense that it's kind of protected from everything else around it, or at least it acts very differently than everything around it. It is this unique little anomaly within a national market. Now, one of the things you may have seen recently, just last week, about 3 days ago, I believe it was on Wednesday that it came out, the TD Bank, after prices have been coming down for 6 months and the Bank of Canada, have shown their cards and talked about what they're doing next, they've had the balls to come out and say, hey, prices are going to drop 25% nationally. And again, we've already seen some areas drop as much as 45%. So funny to kind of come out this late in the game, in my opinion, with this type of prediction, but 25% off of the peak, not 25% more from where we are today, 25% off of the peak. And while that would be, should it come true, the largest drop in history, Canadian history, it would ultimately only wipe out about 2 years of gains here.
It kind of put us back to where we were.
Yeah, it takes us back to approximately mid-2021. So, oh my goodness, it's only about year's gains. My apologies.
Yeah.
And then, of course, by that time it would all be done, which again would probably take another 6 to 8 months by their prediction. It would ultimately still be about a 10% gain on average over the 3 years.
Which is still very healthy.
Exactly. Well, it's more healthy. I'd way rather see 10% over 3 years than 40% over 2 like we just did.
Yeah.
Now, while they quote unquote call this a violent market event for this unprecedented decline, they kind of are a bit nuanced here and also say, just based on how much that it really did climb in those last 2 years, by dropping 25%, it's really just a market recalibration. Much softer word. Recalibration didn't get the headline for some reason, but that's, if you read the whole article, they're really just calling it a recalibration. I'm not hearing panic here. They're just kind of saying what the market's saying. Things were too hot for too long. It's calming down. Prices, understandably, will follow that.
Yeah, I think also when you consider where inflation's at, which is the big fight for the Bank of Canada at this point, and their target rates are still low. So, I still think we're going to see rate hikes into 2023. And I don't think, it might slow down, it might soften. Hopefully it does. But until we see inflation come down, right, really start to come down, until the back of inflation has broken, these rate hikes are going to continue. They just may get softer over time.
Oddly enough, so this is funny, the day after this TD headline capturing article comes out, the 25% declines, the next day, the August stats came out for the Toronto area. And real estate prices went up in August in Toronto. That was
interesting.
Largely unexpected, I'm sure, by a lot of people, probably even the Toronto Dominion Bank. Yes, it was a minor increase. Average prices came up, or HPI prices came up $5,000. And this is on the back of sales increasing by 15% over July sales. But what you must notice here is that does end a 5-month slide. So prices had been falling off a cliff in Toronto, no doubt about it. They were down, I believe, 13% HPI, and then they've just kind of hit a bottom. Now it's 1 month. Of course, that's not a trend, but it is a bit of a stopgap from what's been happening for 5 months. And we will be watching this one closely, and obviously quite curious to see what happens in that region next month. Because if it increases even incrementally then as well, there's going to be some very different conversations out there, because we know people buy into momentum. And as it's gone down, people have acted like prices are going down forever. But once they start going back up, we often see the mentality change.
It'll be interesting to see. And if it does take place, I think you're going to have more inflation issues. The economic activity, by its very nature, creates inflation. So, if people get, there's still 1 million job vacancies, we're still at record low unemployment rates, that continues to persist, and people are continually demanding more money and going out, and we stop seeing the slide, we're going to see more inflationary pressure, which means interest rate hikes. So it's going to be, I think the easy interest rate hikes have happened for the Bank of Canada. They were easy for the last 5 hikes. We need to bring it down. So slap, 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 slap. Now it's going to be very interesting to see how we go forward here, because now the delicacy is going to take over. It's going to be a much more difficult, much more difficult year ahead for the Bank of Canada than what they've just gone through.
It's going to be an interesting one, no doubt. They're painted themselves into a corner. It's a bit of a no-win-win situation here. But like you said, they've got their mandate, and that is bringing inflation under control. Okay, as always, thanks so much for watching and listening. September is going to be very interesting. We are feeling buyers coming back. We're feeling that pressure, and they're still saying to us, there's nothing good to buy. So it's all going to change. The fall market is back here. I think it's going to be unlike any we have seen before. And keep an eye out for that September 7th announcement. We will be doing a special release right after that announcement. As we do, Mikhail Ferreira from the Bank of Montreal will be here with us. That will be released somewhere around 10 a.m. on the 7th. So look for that. We're going to let you know where things stand, especially with trigger rates. Rates are getting triggered with this next announcement, all but guaranteed. We're going to break down what that could look like for your mortgage, and of course, how much more prices may shift thanks to that rate hike. See you next week, and have an awesome day.